My name is Jeff Wood. I am a senior loan officer here at HomeStreet Bank. I've been with HomeStreet Bank 23 years now. And we're going to talk about buying a home and just kind of going through the process and just kind of going through what you need through the buying process as well. So the outline that we're covering today, we're just do why are you here on an online class during your lunch hour? Benefits of home ownership. We go through home equity. We're going to talk about credit building, possible tax deductions. We're going to talk about your stability, kind of your community that you're building within your home, and then retirement. We'll talk about those things. Home buyer basics will go into what you need to get started. On buying a home, establishing your team and next steps. And then the last thing we'll talk about is your benefits at University of Washington with Affinity and HomeStreet Bank and what we do as a non-commissioned loan officer. So the first thing we'll talk about is benefits of home ownership. So what are the benefits? So the main benefits are home equity. So a lot of people are like, what is equity? I don't understand equity. So the biggest thing, it's the difference between your current value of your home and any outstanding liens on your house. So if you have a $500,000 mortgage and your house is valued at $800,000, you have $300,000 worth of equity. So it's the just the amount of equity that you have. It's your wealth within your family, and you keep building that as you pay. So how do you grow your equity? So proper home maintenance. You want to keep your house up to date. You want to make sure that nothing's in disrepair. You keep your plumbing, all of your fixtures in order. You make sure you go through your inspections, and you just kind of keep it through the seasons and having it all taken care of. Home improvement, so you can improve the home. A lot of times adding window or getting new windows and things don't add a bunch of value. They can give you more peace of mind because you're not wasting as much electricity to heat the home. So some improvements give you more equity. So if you're extending the house, if you're making it bigger, more square footage, adding bathrooms, adding bedrooms, that usually gives you more value. Whereas you just replacing the siding, you had siding on before, it's not as huge of an upgrade if you replace the siding or even the roof. They expect you to have the roof on the house. So but other things like solar or ADU units, those can add value to your house. Neighborhood improvements. So having your neighborhood have a viable playground or having a sport court or something like that can actually add value to your neighborhood. Market conditions also, supply and demand. Right now, it's still a seller's market. Nobody wants to move. Everybody has great rates. They don't want the new rates at 7% right now, 6.5%, 7%. So it's really a supply problem right now in the Seattle area. And so houses are selling for a lot more still. And then as you pay the loan down, the decreasing of your loan amount will increase your equity as well. So if you decrease the amount owed on the home plus appreciation in the market, that helps you grow your equity. The other parts of the other benefits are building your credit up. So 35% of your credit score is based on your payment history. So it's tiered. Usually your house payment is your highest tier, your car payments next, student loans, credit cards. So 35% of how you make your payment history goes into your credit score, and houses are one of the biggest things on there that will give you your best credit score. So looking at your credit score, making your payment on time, you want to make sure that you're not late. 30 days after your due date is when it starts showing up on your credit report. So if you have a payment due on July 1st. If you miss it on July 31st and pay on August 1st, that's a 30-day late. That really affects your credit score and drop it down quite a bit. The next part is the amount of debt you have, 30%. So you want to keep credit cards at 25% or less of their high balance. That helps your credit score improve. So if you have credit score at $30,000 credit limit, you want to get that paid down to $7,500 or less. That will help your credit score build up quickly. Also, possible tax deductions when you buy your home. Some of the costs are tax deductible. Mortgage interest, property taxes, some things are tax deductible. So you can write those off, a little bit more benefit at tax time. Let's see. Now, some other benefits, stability in this market, rents going up. Even taxes and insurance, your homeowner's insurance can go up on properties, but your principal and interest will stay the same, especially on a 30-year fixed mortgage. You know what your monthly payment's going to be. Yes, taxes and property insurance may go up a little bit, but you know what your payment should be for the next 20 to 30 years, depending on how long you live in that home. So you can budget your house with all the costs from year to year, so you know what you're paying. So you know what your electricity bills are, you know what your water bills are, you know sewer bills, septic, any of those things that you have, you know what those bills are going to be. Then interest rates subject to change. So you want to just talk to your loan officer about it, with what your terms of your loan are, if you want a 30-year fixed, and kind of keeping that payment stable for what you want for the future. Next part is just talking about adjustable rate mortgages real quick. Adjustable rate mortgages, everyone's like, oh, I don't want that because it can change. Adjustable rate mortgages in the right time might make sense. They're usually fixed for 3 years, 5 years, 7 years, or 10 years. And it really depends on what type of ARM or adjustable rate mortgage that you want. And sometimes they're fixed for 5 years, like a 5/1 ARM. It's fixed for 5 years. It'll adjust every year after 5 years. You'll see a 5/6 ARM. It's 5 years fixed. It'll change every 6 months after the 5 years. So when you see the different changes on the ARM products, again, it's 3, 7, 5, or 10. It just depends on how long those are going to be fixed for and how long you plan on living in that house or having that specific mortgage. Because usually 85% of homeowners will do something with that mortgage in the first 7 years of owning their home. So sometimes a 7/1 ARM or 7/6 ARM makes the most sense. Right now, ARM products are a little more inverted, and so the rates are higher right now than 30-year fixed. So the market is really kind of upside down right now for ARMs. So it just depends on what time of the market it is. Right now, 30-year fixed is a lot better than an ARM product. So you want to talk with your loan officer about that. Next part, freedom. You've got privacy and reflection of your own personal space. So you can do what you want with the house. You don't have very many restrictions for pets. Unless you have a specific HOA that's restricting you, like in a condo or a specific community, you do need to check your CC&Rs, that's your covenants, on any restrictions that you might have. Like mine, you can't have chickens. So, but you can have regular animals as long as they're family pets. So you have to look at different things like that. So some communities want to have chickens. You want to look and see if that's something that's allowable. And then just community neighbors with homes that are all owner occupied usually have a better pride of ownership within the neighborhood. They take care of the property, they mow the lawn, they keep it watered, they keep all the weeds picked up and taken care of. So pride of ownership, the community that helps with the benefits within home ownership. And then surrounding amenities within the community depends on it can help improve your values. Like I talked before, your playgrounds, your sport courts, your pools, a lot of different things that you have, sidewalks, landscaping. So there's a few things you can look into. And then the last one is retirement. So knowing your mortgage be paid in full at a certain time is very helpful. I have customers that are always asking me, okay, can I do a 15-year, or how do I pay my 30-year off in 10 years because we've been here so long? I want to have it paid off in 10 years. So you can work on ways of paying it off early, or you can refinance and pay them off sooner if you do a shorter mortgage. So you don't always have to do a 30-year fixed mortgage. You can do as short as an 8-year term. You can do a 15 or 10-year terms, depending on if the payment is something you want to do. But if it seems like it's a stretch, keep your 30-year mortgage, especially if you've got one of these great rates at 2.5%, 3%. Make extra payments on it, because refinancing to a 15-year, you're going to pay more interest right now. So make double up on your payments there, or take the extra and put towards your retirement. So there's different things you can do with that, and just build your retirement savings up and keep paying on the low interest rate. But the other thing is a lot of times with retirement, you can take your house that you've been living in for a while and maybe downsize. And so you can use the money that you own the house. And I have a lot of customers that will sell their house and then they'll buy the other house free and clear. So they've downsized, able to buy the house with no mortgage, and then they live just paying your taxes and insurance on the property, and they live basically rent free. So that's a nice part about setting yourself up with buying your home. Next part, we're just talk about the basics, how to set up your team and how to get everything ready to buy your first home. So first thing you want to do is just kind of create a budget. You want to find your wants, your needs, and just kind of figure out what your payment needs to be for your home. I usually say, let's figure out what your mortgage payment's going to be based on what your current rent is. So let's say you pay $2,000 in rent, your mortgage is going to be $3,000. So you want to take that extra $1,000 every month and put that in savings. So you act like you're making that $3,000 payment. It's called payment shock. So you make that payment, you put that $1,000 in savings, see if you can live normally without touching credit cards and overspending and not touching that $1,000 or increasing your amount owed. So it's a great way to kind of get your budget set up, figure out, oh, does this work? Or no, maybe we need to dial it back to 2,800, put $800 in savings. So look at that. And then it sets you up to know how much that payment's going to be and what your budget's going to be. Because the biggest thing is when customers I've had that have got into house and they've stretched to the very maximum, they've put themselves in a place where they can't do anything else. They have the house payment and they live at home and that's about it. They don't have any other, they can't do their vacations. They can't do their movie nights. They don't go out to dinner. So put that stuff into your budget, make sure those things are in there because you're going to want to do that once you have the house. So you have the freedom of still owning the home and doing the things that you're used to as a family. And also it helps you save money once you've put that money in, put $800 or $1,000 away every month for 6 months to a year. You start building up that savings. So you might not need 20% down, but you might save enough up to 3 or 5 or 10% down for your down payment. So with the down payment savings, again, you don't have to have 20% down. We also have special programs for down payment assistance. You can be a first-time home buyer, or you can have owned a home before. We have different programs within Washington State. And then also they want to make sure you have funds after you close. So they don't want to have you put everything in savings into the house and then suddenly your house poor because you don't have any savings. So get that savings built up. Make sure you have a little nest egg to fall back on if needed. Next part is we talked about credit scores a little bit. Get your credit score built up. 35% is based on your payment, like we talked about. 30% is based on what you owe, how long you've been using credit cards, and then also new applications. So everybody's like, oh, my credit score is going to drop if I apply for new credit. If you apply for a mortgage, you have 45 days to have your credit pulled by other lenders and your credit score will not be affected. So you can go and have your credit score pulled by 2 or 3 companies, get their quotes and say, okay, I'm going to use so-and-so. If you go out and you have your credit pulled for credit for buying a home, and then you go and shop for a car, and then you open 3 credit cards, yes, your scores are going to drop because you're inquiring about other debt. And they think, okay, they're going out and buying a whole bunch of things. So your credit scores can lower a little bit. So you want to be protective of that credit score, especially if you're shopping for a house. Again, minimum FICO scores, you have to have one account open for 6 months. And then no indication of being deceased on the credit report. That does happen sometimes if you have a spouse that's passed away. Sometimes they get tagged on your credit report. Our credit reports are good for 120 days. And then credit freezes. One of the biggest things I have when customers apply, they forget to take their credit freeze off. I have to have the credit freezes removed for 24 hours, and then we can have your credit pulled. So we'll pull that, and then you can take your credit freeze and put it right back on there. It's very common these days to have your credit frozen, so to prevent fraud. Next part. Okay, so to kind of talk about the steps for buying the house. First is applying for a home loan. You can submit your loan application at any time when you're ready to move forward. Typically, it's good for the 120 days that your credit report's there. We usually keep them open for up to a year. But what you need is usually 1 month's worth of pay stubs. So with UW, you're paid twice a month, so we'll need 2 pay stubs. If you're paid once a week, we need 4 pay stubs. If you're paid monthly, like some teachers or some other employers that we work with, we need 2 months worth of pay stubs. That's the only time is if you're paid once a month. Let's see, next thing is 2 months bank statements or investment accounts. We typically need the accounts for where the money's coming from for your down payment and closing costs. So it's not something where your pass-through account has a couple $100 in it after all your bills are paid. we don't need to see that. We just need to see where your savings, where your money's coming from for the transaction. Now, if you are getting a gift or anything like that, we can work on the gift funds because we do need a gift letter and track that money coming into your account. Most recent W-2s for 2 years for W-2 employees. If you're self-employed, we do need usually 1 to 2 years of tax returns, mostly 2 years of federal tax returns for self-employed borrowers. Let's see. Feel like I skipped a slide there, sorry. So the next part is just buying the home. So once we've got you approved, you've got your pre-qualification, you want to establish your team. So you've got your loan officer, you've got your pre-approval, we've gone through your loan application, we've kind of gone through all the information, your down payment, closing costs. We know exactly what you're looking for buying a home. You want to start and talk to a real estate broker. Now there's different types of real estate brokers. There's regular brokers out there. There's realtors, there's realists, there's different categories of realtors out there. You just have to know kind of what their experience, you do their interview. We work with some within our program as well, but you want to talk to a couple, kind of like you're doing with loan officers as well. Just get a right fit for that loan, for that real estate broker, just to kind of see if that they fit your needs and they're looking in the areas that you're looking, that they know the areas that you're looking in. Because the main thing is you don't want to work with someone that's doing it part-time. Because a lot of times they might not be there for you when you need to see a house. So you got to be careful with that. So find out if they're full-time brokers, if they do this for a living on 100% basis, because they'll be working for you. So you want to check with that, because if they have a 9-to-5 job as well, plus being an agent, you got to be careful, because when you want to go see a home at noon, might not be able to. So keep that in mind. Let's see. Next part, once your offer is accepted, notify your HomeStreet loan officer, because what we want to do is start pricing it for you. I'm just going to say, this is what rates are. This is kind of what your program looks like. So we want to figure out what your payment's going to be, because there's different ways of pricing the loan that we want to make sure that it fits what you want and what you want to have for a payment. We got to confirm any contingencies or escalation clauses with the realtor within your contract. Now you make your earnest money deposit. That the earnest money deposit is your good faith that you're going to buy this property. You can go through the process once they accept your offer. And if you back out, they could keep that earnest money. So the realtor's job is, and the loan officer's job is to protect your earnest money. So when you're going through, you put in the earnest money, it's anywhere from 1% of the purchase price to, I've seen $150,000 to $200,000 for earnest money. We want to protect that. And that's why you have your contingencies. That way you have different things, your financing contingency, you have your appraisals, a contingency, insurance and contingencies. There's a lot of different things that you can do to protect that. So if you back out, that money is protected. Now, if you get down to closing, you're ready to close and you say, I don't want to buy the house. They can take your earnest money. So you need to be careful of that. So once we get through the process, you'll pretty much know if you're buying the house or not, because you got to go through your home inspection. They are optional. I do recommend having them, so you at least see the house. Sometimes people do pre-inspections so they can get their offer accepted, but still have some sort of inspection to make sure the house is in good working order. So once that's done, we will order the appraisal. So once the appraisal's ordered and we receive it, the value condition, we'll review the whole package to make sure everything looks fine and for your approval. So that's kind of the last thing that we're waiting for within our process is the appraisal to get your final approval. So once you have your final approval, we send out the final documents to sign. So once we get those to escrow, it's usually about 3 days prior to signing and closing. We get you to sign your final documents. Now, the biggest thing is sending closing funds. Escrow will contact you typically to send you the funds. Usually if it's an unsolicited email, just saying, oh, we need 5% sent to so-and-so at this time, be careful. You want to talk to escrow personally. You want to call them. You want to talk to them over the phone, get their information and find out what their wire instructions are. and also talk with your lender to see if that sounds about right. The main thing is because there's a lot of wire fraud out there. I've actually had a realtor and a customer where they spoofed his email and they said, we need our 5% sent to us by Monday, otherwise we could lose the transaction. Well, luckily for them, it was a 3-day weekend and they couldn't send it on Monday. So they called the realtor up and like, we can't send the 5% right now. We can send it on Tuesday. And he goes, what are you talking about? You go to close for another week. And so they were trying to get them to wire the money on a Monday, just to hurry up and get the money out. So they could have lost $15,000 really quickly. So you want to know who you're sending your money to. And so once you've wired your money to escrow, you've signed your documents. Typically, you wait to the next day. We will close your transaction with escrow, and escrow is the third party that will sign your documents and move the money around and record your documents with the county. So once you record your deed of trust with the county, that's when the house becomes yours. And then that evening typically is when you get your keys, unless the realtor has arranged something with you prior to that. So sometimes they meet you at the house and get you the keys. So each agent is a little bit different. So we'll talk about real quick on the affinity benefits with the benefits package for the University of Washington. So with our loan officers, they give you up to 0.5% of your loan amount towards closing costs. So on let's say a $500,000 loan, you get a $2,500 credit from HomeStreet Bank. We have participating realtors that we work with. I spoke about before. They give anywhere from 0.5% to 1% of the purchase price. So $800,000 purchase price, you can get anywhere from $4,000 to $8,000 towards closing costs as well. So between our discount of $2,500 and there's a $4,000 to $8,000, you can get about $6,500 to $10,000 towards closing costs on your purchase. And now down payment assistance, we work with down payment assistance throughout Washington State. So it just depends on what county, what city you're looking at. Next one is financial tools. So classes like this, we have free seminars that we hold for Lunch and Learns monthly here at UW. We also have some recorded ones that we have on our website as well. We send out newsletters and other podcasts as well for HomeStreet. Benefits are available to you and your immediate family members. So if you have children or parents that are looking to buy, they also get the benefits that you get as well. Excuse me. And then also this benefit is exclusive through our affinity program. So you want to contact one of us for the benefits. There's 4 of us in Seattle. It's just me, Denise, Jessica, and Ryan, but my information's here. So if you have questions later on, I'm happy to answer those questions. If you have any questions for after this, I'm happy to answer questions afterwards as well. But my information's here if you want to give me a call, or the hotline number is the 206-628-0207. That's our hotline number, which we answer Monday through Friday from 8 until 9 at night, and Saturdays from 9 to 5. So we are available. So, but you can also check out your benefits at homestreet.com/UW.
Amazing. Thank you so much, Jeff. That was a lot of information to run through really quick, but yes, if anybody has any questions, please feel free to use the Q&A function or the chat, or if you'd like to voice your question as well, you're free to unmute yourself. But Jeff, we did have a question come through, and looks like someone asked, how often do taxes change? I'm recently seeing people complain that their mortgage payment went up because their taxes went up.
So the property taxes, depending on your county, can go up on a yearly basis. So depending on which county you live in and what your what levies or bonds that are passed within your county can increase your property taxes. So, or you see a lot of times with some of the light rail or I saw it this morning on the news, light rail or the transit authority, they're increasing the taxes. I think King County was saying that they would move it up like $44 a month. Was it per household? I think is what it was going to go up to. But that was also the old levy was expiring. So there was a little bit more of an increase, but the old levy decreased it. So it just depends on really what county you live in. But yes, they can go up each year. I've had a couple times where they've gone down. It doesn't happen that often. Lately, things seem to be costing more, and so the county is charging more. So, because they still have to collect that same amount of money each budget period. So, you don't see it go down very much. They do increase. Insurance has been the biggest problem in Washington, Oregon, and because we do mostly Washington, Oregon, California, and Hawaii. Most of the insurance companies are pulling out, and they will only insure you if you do your bundle of car and home a lot of times. So be cognizant of that when you're buying a home. Your current insurance company may insure you. If you're shopping around, they may only quote you if you do your car and home. That's very common practice right now in Washington. And unfortunately, it's getting tougher to get homeowners insurance on your house.
Understood. Thanks, Jeff. And then there's another question here. What time period of income is typically looked at when applying for a loan? What if your income has changed in the past year?
So a lot of times we'll do a 2-year average in most cases, unless you have a job that let's say you were given a promotion. Sometimes we can use that income, the future income, as long as you start getting it by the time you close your loan. So sometimes I have a lot of customers that, let's say they've gone through the residency or then they get hired by the university. We can use that income that the university is paying them as they're moving into your, let's say September. We can actually use that to purchase a home for the future income that we're going to be using. So we can use that. We don't look as much as the past. Now, if it's self-employed borrowers, we typically do a 2-year average of their self-employed income. We have to have full tax returns. We'll do a 2-year average and see kind of what a year-to-date profit is. So for 2024, we'll take the first 6 months of 2024, see what their income is, compare it to the last 2 years. So there's different things that we look at for self-employed borrowers. But typically we use what you're getting paid on your pay stub right now. As long as you've been doing that in the past, typically you got to show that you have a 2-year history of it. But again, if you're going to school and then you have a new job because of what you were training for, we can use your current income. So there's a lot of like intricacies with the income and what we can use, but typically we can use what you're being paid right now in most cases. Hopefully that answers.
Oh, awesome. Thank you. Someone else asked, are there any special loan products available for people working in education? I'm guessing aside from the affinity benefit that we have.
So we do have they do the home opportunity program, but they also have a teacher benefit. It's kind of the same thing as house key opportunity. So for first-time home buyers, it's a $15,000 down payment assistance program. With your first mortgage, you can put as little as 3% down, so you can get the $15,000, and that can help with your down payment and some of your closing costs. That's one of the ones for educators that we use. But if you fit income guidelines, we can actually fit it for others that are not teachers as well. There is a new program that's coming out. You may hear it in the news a lot. It's the Covenant program. So if you have a family member, if you have parents or grandparents that have lived here since 1968, April 1968 or earlier, and they're a person of color, they have a specific group of people that were discriminated against before April of 2000 or 1968. And so if you can show that your parents were living here and you're a first-time home buyer, the Covenant program can help with 20% down and closing costs at 0% interest. So it's a great program. They're just rolling it out right now. And the classifications that they had were Native American, Hawaiian Islanders, Pacific Islanders, African American, Hispanic, and I apologize if I'm missing any right now. I'm just going off memory because we just took the class. But if they've shown that there's discrimination within that specific group, they qualify for this program. We just have to prove that you had family living here in 1968 or sooner, to prove that they were part of Washington State residents, and you have to be a Washington State resident to qualify for it. So it's a very new program. It's actually the first in the nation for it. So there's a lot of things going on with it still, trying to get that out the door. So that's one of the newest ones we have. It's actually, and it's up to 150,000 in down payment assistance. So you can buy a $750,000 house with 20% down, and all your closing costs are covered. It's actually pretty neat.
Yeah, 20% down. That's quite a bit at zero interest.
Yeah, it's huge. And I think the rate was, I looked yesterday, it was like 6.75, which is really good on the interest rate for this
Yeah.
market.
We had a couple more come through. Someone asked, how does it work if you have two jobs, full-time and part-time? Would you incorporate both incomes?
So we have to show that you have the part-time job for 2 years or longer. So you can't just, they do that because they want to show that, okay, you've had a full-time job and then suddenly you picked up a 20-hour-a-week job just to qualify for a home. You have to show that you've done that 20-hour-a-week job with your full-time job for 2 years or longer to use it. Otherwise, we can't use it because they think, oh, they only took the part-time job to qualify for more.
Thanks, Jeff. And then it looks like someone asked, does the 15,000 first-time homeowner down payment assistance program have income limits?
They do, and it's 80% of the median income for King County or whatever county you're looking in. So for a family of two, I believe, I'd have to look at it. I want to say it's 88,000 for the second mortgage, and then a family of three or more, I want to say it's 103 or 107. I'd have to look for King County. Each county's different, so I have to look up every time I'm in a different county and who's buying in that county. But we do have another one that does 4% of your purchase or of your loan amount at 0% interest as well. So if you don't qualify, and that income goes up to 180, I believe now. It was 160, I think it's 180 now. So if you make 180,000 a year, you can get 4% of your purchase of your loan amount towards closing costs. So we do have that program as well.
Awesome. And someone asked, is it important to pay off student loans before purchasing a home in case the interest rates are similar? Say 6.75% mortgage and a 6 and 8% on student loans.
It's really, you want to look at it when you're doing your budgeting, if it's something that you can afford once you own the home. Because you have certain benefits with student loans, or if some student loans are being forgiven, paying them off. It really depends on what category they are with the type of student loans, and also if it's affecting your purchasing power. So sometimes if there's a deferred payment or if it's a smaller payment, it's a lot better just to leave that alone and still qualify for the home loan as long as you qualify for it with that payment. It's kind of the same with the credit card debate. It's like, do I keep my savings or do I pay off my credit cards? The savings is sometimes more needed for buying the house than paying off that credit card that's $100 a month payment. So you want to look at the kind of the benefit of one over the other. So you have to kind of see if it makes sense to pay all your credit card off and qualify for more of a home, but not have any savings to put the down payment. So it's a fine line to kind of crunch those numbers.